whole idea of the boot camp is, again, we're doing a full day of education, is that there are tons of webinars out there. There's tons of videos to watch. There's tons of things to read. And they all live in their own little ecosystem. They're 30 minutes long, 60 minutes long, etc. That's not enough to really get deep. The whole idea is we want to take you from zero to hero throughout the course of the day. And so that's why we string together this amazing group of educators so we can get deep and get to that expert level. For sure. So without further ado, I am going to bring Tony onto the bootcamp stream. Tony, what is going on, man? How you doing?
Good. How you doing? Can you hear me all right?
I can hear you. A-okay.
Excellent.
Awesome. Did you have some fun watching our live trading?
I did. Interesting. You guys are good guys.
We have some fun with it. But Tony, I will step out of the spotlight, let you take over. And if you wouldn't mind, could you just give us a little bit of background on yourself first things first?
Absolutely. So good morning. My name is Tony Venosa. I'm a trader with Schaeffer's Investment Research out of Cincinnati, Ohio. I've been with Schaeffer's for the past 12 years and have over 2 decades of trading experience. Schaeffer's Investment Research has been around for over 40 years, founded by Bernie Schaeffer. We offer real-time option trading services to investors, as well as print and media educational offerings, including daily, weekly, and monthly newsletters. I'm excited to spend the next 30 minutes giving you a brief introduction on how I use expectational analysis to add an edge over other market participants. What does it mean to trade with an edge? What I want to convey to you today is the importance of having an edge, which is having a slight advantage over other market players. You must develop and capitalize on your advantages because sooner or later, the crowd will catch on and the edge will disappear. At Schaeffer's, whenever we enter a trade, we must answer the question, why now? Why should this stock move in the direction you're anticipating, and why should it move now? It sounds simple enough, but it's extremely important to ask yourself this question whenever you execute a new trade. And you should have an honest answer, or you have no business entering the trade in the first place. Also, you should ask yourself, what are 1 or 2 things that you know that others don't? It doesn't have to be complex or illegal, just something that most market players are not observing or taking notice in a particular stock. We are trying to avoid spots where other people will be inclined to enter or exit. We want to identify entry spots where the crowd is unlikely to join us. And finally, are you using quantified data? At Schaeffer's, we employ quantitative analysts whose job is to provide us daily with numerous screens and models based on backtests of various types of technical and sentiment data that provide us with potential edges. Today, I'm going to show you some of the ways we answer these questions when we issue trades. And by the end of my talk, you will benefit by learning some of the edges we use to find winning trades. The single most important takeaway I want you to remember is you must have an edge to consistently profit in the markets. Not only because it'll lead to profitability, but it'll also build the confidence you'll need to succeed. Our methodology at Schaeffer's is a 3-tiered approach to analyzing the markets, which Bernie Schaeffer aptly named expectational analysis, which we believe gives us a leg up on the competition. We use a combination of fundamental analysis, technical analysis, and investor sentiment to uncover trading opportunities the rest of the crowd is missing. Fundamental analysis is the segment most people are familiar with. It involves valuing companies based on future earnings growth and revenues. Many buy and hold investors may use such metrics as price to earnings ratios to determine whether a company is undervalued. I will briefly discuss some of the short-term indicators we use to drive our decisions for option trades. Technical analysis has become more and more popular over the years and essentially the study of past price action and trading volume. It can include such things as price level support resistance, volume, momentum, overbought, oversold indicators, breadth, price patterns, as well as quantitative systems based on backtesting of buy and sell signals. Sentiment is the third piece of the puzzle that we think is not as widely used as the other 2, but has been gaining in popularity over the years. Sentiment analysis is the study of qualitative and quantitative indicators in an attempt to gauge how bullish or bearish the consensus opinion is on a given stock, sector, or market. It is the moods, beliefs, and feelings of the crowds. These emotions and feelings can be affected by a variety of things. The most accurate indicators reflect what a group of investors are actually doing as opposed to what they are feeling or saying. At Schaeffer's, we take a contrarian approach to sentiment analysis by seeking out situations where price runs counter to a security's price action. So let's first discuss some of the ways we use fundamental analysis. When doing short-term trading, we are not looking at traditional discounted cash flow or dividend discount models for projected 5 or 10-year valuations. We are looking for catalysts that can move the stock in a short time period, and understanding where the company will be in a decade from now doesn't give us an edge in our typical time frame of 1 week to 6 months.
And Tony, can I hop in with a question really quick?
Yeah.
So you're talking about your time frame, 1 week to 6 months.
Yeah.
How are you choosing that time frame? Like, is that a decision you're making before you head into the trade? Is it something, as the trade develops, how do you?
It's based on the diverse products that we offer our subscribers. So we have products that cater to really short-term options trading from anywhere from 1 day to 5 days, or longer-term trades from anywhere from 3 to 5 months.
Okay, got it. Awesome. I appreciate it. And now you're going to get into some of those catalysts, it looks like. Is that right?
Yes, correct.
All right, let's hear them.
A stock buyback is a way for a company to return capital to its shareholders. The other more common way is for a company to issue dividends, which represent a percentage of the company's earnings paid out in either stock or cash. We are looking for buybacks of 10% or more, which is significant and could be perceived as a strong buy. During the past 15 years, it has become standard operating procedure for many companies to buy back their shares. A company repurchases their shares in the marketplace, thus reducing the number of outstanding shares available, and will effectively increase the company's earnings per shares. Obviously, this is just one key aspect and should not be viewed as the sole reason for jumping into a stock. The fundamental implications of a stock buyback are merely one more thing to consider when picking stocks. This is a partial list of some of the top buyback announcements of the latter part of 2021, ranked by percentage of outstanding shares set for repurchase. I weed out some of the lesser liquid names so we can actively trade them for our subscribers. As you can see, there are some big winners here, and there are also some big losers. So you cannot just blindly buy based on the buyback announcement alone. It is not a timing tool. You will need additional tools to find a more precise entry spot that ensures a solid risk-reward situation. The first thing I do is create a watch list of the major buyback announcements for stocking purposes. This chart shows the buyback announcement for Crown Holdings, ticker CCK, which announced a 23% buyback plan last December, which equated to a $6 billion purchase. Shares have been showing solid relative strength so far this year, up more than 20% as of March 5th. This is also a partial list of the current top buyback announcements so far in 2022. These names are actively followed by me in a watch list specific to buybacks. Not all buybacks will result in solid up moves, hence my reason for not being a standalone tool. This chart shows the buyback announcement for HCA Healthcare, which announced an 11% buyback plan near the end of January of this year, which equated to $8 billion. Like Crown Holdings, HCA shares have been showing solid relative strength in 2022, bucking the corrective trend in the general market so far. Insider transactions are legal transactions conducted by insiders, usually officers, directors, or CEOs, who buy and sell stock in their own companies. They must report their shares to the SEC within 2 business days. Knowledge of an insider buying or selling a large number of shares can be valuable information to an investor. SEC rules prevent insiders from trading company stock within any 6-month period. So if an insider is buying their company's stock, an investor can reasonably assume the company's fundamentals are in decent shape. Studies show that insider buying and selling is a meaningful predictor of future returns, which is why it makes sense to follow such transactions. A 2019 paper titled Indirect Insider Trading shows that trades made in indirect accounts are more profitable than direct trades in their own accounts. An indirect account is one where the insider has control, such as a family, trust, retirement, and foundation accounts. This is a direct quote from this paper. Indirect trades better predict earning surprises and large price changes, and are associated with opportunistic insiders who make profitable trades before earnings announcements or have short investment horizon. Insiders are less likely to trade through indirect accounts following periods of intense regulatory scrutiny. This is a list I'm currently following of indirect purchases by insiders. Again, this list is limited to some of the more liquid names we trade at Schaeffer's.
And Tony, sorry, let me hop in really quick with one that I'm long. RKT Rocket, that was another one that had one of those big insider announcements just yesterday afternoon, maybe. And so that's another. If you have liquid names up, that's one that I've had my eyes on. Similar sort of trend. I believe they have that stock buyback active right now as well.
Rocket did?
Yep.
Okay. Anyway, so on February 23rd, one of the directors of Dillard's purchased $4.6 million worth of stock in an indirect account. This chart shows the price action through March 8th. Shares continue to hold up quite well despite the broader market selling pressure. Here's a list of indirect sales by insiders. This list is slightly longer than the purchase list, which makes sense due to the broader market weakness during the first quarter of 2022. On February 28th, Michael O'Sullivan, general counsel of Snap, sold nearly $500,000 worth of Snap shares. On March 3rd, I recommended to subscribers to purchase the Snap April 36 strike put for $3.70. 3 days later, we sold half the position for 100% profit. Earnings season is every January, April, July, and October. Playing options ahead of the firm's earnings report is risky, though it can certainly result in large profits if the directional move is predicted correctly. Following the news release, the unwinding of extreme sentiment toward the shares, whether bullish or bearish, could contribute to a prolonged directional move. Initiating a trade after the earnings report can be just as profitable as a pre-event play while reducing some of the risk. On my charts, I plot the earnings reaction day's closing price as a horizontal line extending through to the beginning of the next earnings period. The following Disney chart is an example of how I plot the earnings reaction closes on the chart, which I feel act as significant hidden support and resistance levels, as well as inflection points that often get retested, offering excellent entry and exit points. Here's the daily chart of Disney. When the red and green horizontal lines begin, it depicts the earning days for Disney. When price action trades above the latest earnings day, the line is green. And when the price action trades below, it turns red. What I want to show you is how price tends to respect these levels around earnings reactions. As we can see on the far left-hand side of the chart is the August 2020 earnings upside gap, which was represented by the green horizontal line. Shares came back on 2 occasions in September and October to retest this level. And finally, in November, shares closed the August gap before the next earnings in November, which resulted in an upside breakaway gap. Another pattern I want to show you is the first 3 earnings periods of 2021, which are contained in the yellow circle. Shares oscillated around each level, going really nowhere for much of 2021, and in hindsight, can be viewed as a major distribution period until November earnings report, which caused a sharp breakaway gap lower from the tight consolidation zone created during the first 10 months of the year. I believe there are numerous patterns and insights to gain by observing earnings reaction days and how shares can often revisit these levels throughout the quarter. Let's quickly move on to technical analysis. I'm going to now briefly discuss an aspect of technical analysis that I think is unique and not discussed frequently. Blind levels are levels you won't see on most charting platforms, and it does take some extra effort to create these, but I assure you it is well worth it. These levels show a potential for support or resistance that most traders are unaware of because most may be looking for your typical price level support or resistance. There's nothing wrong with this type of analysis. In fact, I use it also. But I would like to find levels to show me potential entries and exits with the objective of avoiding crowded trades and also answering the question, why now? The optimal trades to make are the ones where multiple levels come together, thus strengthening the case for support or resistance. Our quantitative analysts run screens every morning to aid us with this type of analysis.
And Tony, can I hop in with a question real quick?
Sure.
You mentioned crowded trades. Can you just define that for us a little bit more?
A crowded trade
why
is
you don't like them?
Basically a trade where it's a popular area where most people think they should get in, like a bull flag breakout or something. It's pretty obvious to any chart reader 101, you know?
Yep, I get it. So you're going more under the radar. That's where there's more alpha, more money to be made.
Correct.
Awesome.
We believe paying attention to a company's market capitalization level can reveal important levels not found on a typical price chart. It amazes us how market cap brown levels can often act as magnets while also serving as support and resistance levels. Here's a market cap chart of Microsoft. Microsoft hit the round number $1 trillion market cap level for the first time in April of 2019. It was quickly rejected until a few months later when it successfully overcame this key level. Shares held above this level until late fall, where shares rallied into the first part of 2020. A pandemic-induced sell-off sent shares back to retest this level in the spring of 2020. Flash forward a year later to April of 2021, as shares tried but failed to hit the $2 trillion market cap level. Round number market cap levels are a great way to find potentially hidden support or resistance levels and can also be used as targets. Year-to-date return levels, specifically the 0, plus or minus 10, 20, 50, and 100% year-to-date levels, are also extremely important to observe, as they will often serve as support and resistance. This is an example of our year-to-date screen from March 8th, which our quantitative analysts route to us each morning. It shows stocks that are trading near significant year-to-date levels, which we believe have a tendency to act as support or resistance. This is a 60-minute chart of fertilizer producer Mosaic since the beginning of 2022. You can see on the chart how shares respect these year-to-date levels quite well. Shares made an initial rally to begin the year, but stalled at the plus 10% year-to-date level shown in turquoise. Near the end of January, shares overran the 0% year-to-date level, but quickly rebounded and held as support. Shares rallied in February, but found the plus 20% year-to-date level shown in gold to be formidable resistance. In late February, shares broke out after the fifth test of the 20% level. On March 8th, Mosaic was trading near the 50% year-to-date level shown in green, which made it onto the year-to-date screen. This level served as a roadblock for shares until a strong up move sent shares soaring through this recent consolidation just 2 days ago. I can't overemphasize an awareness of unique levels on a price chart. It's an extremely important attribute of any successful trader. A stock's IPO or initial public offering price and the respective multiples are also important to observe. Perhaps because significant institutional sponsorship holds shares with a cost basis of its original IPO price. We see multiples act as targets for these institutions to take profits. Here's another screen sent to us each morning. It shows stocks trading near its IPO price and multiples of the IPO price. These levels, not typically shown on charting programs, have an uncanny ability to act as magnets. This chart is of Chinese car maker Li Auto, ticker LI. On March 8th, this stock appeared on our screen as it was trading 1% below the $23 level.
And Tony, real quick, like when you're looking at these IPO multiples, this is super interesting. I don't think I've heard this one before. You're not just looking at recent IPOs. It looks like you're looking at like I think I saw Visa, Verizon, or one of those.
I would
big
say
board
stocks that have had IPOs in the past 4 to 5 years,
Okay.
and the more recent ones, yes.
Okay. Awesome. This is a neat concept.
On March 8th, this stock appeared on our screen as it was trading 1% below the $23 level, which is 2 times its IPO price. Looking back over the history of Lee, we can see many instances where shares respected these multiple IPO levels. On the left-hand side, in late November of 2020, shares made a climactic high just above the $46 level, which is 4 times its IPO price. And since June of last year, shares have been contained between the 2 times IPO price and the 3 times the IPO price, both acting as strong support and resistance. Okay, let's move on to odd moving averages and quantified data. At Schaeffer's, we follow several moving averages where some are popular and others not followed as much. We find stocks will respect certain moving averages. Specifically, we follow the 40, 80, 160, 200, 320 unit moving averages on the monthly, weekly, daily, and 60-minute time frames. Each stock has its own unique way of attaching significance to one or some of these moving averages. Some stocks, while in uptrends, like to experience deep pullbacks to longer moving averages, while others prefer shallow pullbacks to shorter moving averages. With the help of Schaeffer's quantitative analysts, we have access to daily screens that help narrow our focus. This is a sample of a screen from March 7th, which shows stocks that have pulled back to their 40-day moving averages and their respective returns and win rates for 5-day and 21-day periods. This is a chart of biotech company BioCryst, ticker BCRX, which pulled back to its 40-day moving average, shown in red on March 7th. During the past 3 years, BioCryst pulled back to the 40-day moving average on 4 separate occasions. The average 5-day return was 4.5% with a 75% win rate. The average 21-day return was 7.5% with a 67% win rate. Obviously, the sample size is small, so I do not endorse it as statistically significant, but it is a good starting point for finding stocks that are pulling back to not widely follow moving averages. I encourage you all to experiment with some of these unpopular moving averages that may provide some valuable insights. Let's discuss the final piece of expectational analysis, sentiment analysis. This was a quote in Humphrey Neal's book, The Art of Contrary Thinking, which I think sums up the approach we take on sentiment. At Schaeffer's, we take a contrarian approach to sentiment analysis by seeking out situations where the prevailing sentiment runs counter to a security's price action. I'm going to quickly run over a few sentiment indicators that I personally use in my analysis. Short interest is one of my favorite go-to indicators for sentiment. It measures the level of investor pessimism by the number of shares sold short on a particular stock. There are 2 ways we measure the level of short interest. The first way is as a percentage of a stock's total float, which is the total number of shares of a company available for trading. A reading of 10% or more is viewed as heavy pessimism. The second way is called the short interest ratio, which is the total number of shares sold short divided by the stock's average daily volume. The ratio represents a rough estimate of how many days it would take investors to buy back all their shorted shares at the stock's average daily trading volume. From a contrarian viewpoint, we see this pessimism as bullish for the stock if it is in an uptrend. Because a short seller has unlimited risk, the pressure to cover will build as shares continue to march higher. There is a flip side to this analysis. Elevated short interest can be viewed as bearish in the context of a downtrending stock. We consider the bears to be in control of the stock and continued downward momentum give the shorts little reason to exit their winning trades. Here's another screen that we receive every 2 weeks after the newly released short interest data is made public. This screen attempts to find stocks with high short squeeze potential due to the large losses on the bear side. This screen was sent to us on January 14th of this year. As you can see, there are multiple energy names near the top of the list. Fast forward 6 weeks from January, and we witnessed some spectacular moves in these same energy names.
And sorry, Tony, let me hop in for a second. When you're looking at losses on the short side, is there like a certain percentage that it starts to become interesting for you? Like a 10% loss in the shorts. Is that interesting? Is it 50%? Is it 100%?
We have the list ranked from the highest losses all the way down, but yes, the higher is obviously the better. So, but yeah, it goes all the way down to just break even basically. So we can go through each one and decide if there's other factors or drivers that we can look at to get into a trade.
Awesome. All right. Thank you, sir. Appreciate it.
So in fact, our founder, Bernie Schaeffer, recommended to subscribers on January 24th to purchase the Peabody Energy, ticker BTU, April 10 strike call. Our research had determined that Peabody Energy had a 45% increase in short interest during the past year, and the average price of entry for the increased short position was $6.55. As of January 14th, Peabody closed at $12.47, estimating that the bears were sitting on a 90% loss on their position. Bernie recommended a profit target of 200% on the call, which was achieved 14 days later on February 10th. Another real money sentiment indicator in our toolbox is the buy to open put call ratio, which we feel can reflect degrees of optimism or pessimism in a stock or index. We calculate the put call ratio by simply taking the number of puts bought to open on the day and divide that by the number of calls bought to open on that day also. We can calculate these on individual stocks, indices, or the overall market. The theory is that near market lows, the put call ratio will be high, usually greater than 1, reflecting more puts being traded relative to call options, thus reflecting pessimism on the stock. When this ratio is near or at an extreme, it can mark a bottom. Conversely, an extreme low in the put call ratio can reflect strong optimism in the name, which could signal a potential top. Thus, the put call ratio is mostly viewed as a contrarian indicator when it reaches extreme highs or lows. This screen displays stocks that have a 10-day buy to open call put ratio greater than 1, and it ranks in the 90th percentile of its own annual range. This means a large number of calls are being purchased relative to puts, which is usually a sign of extreme optimism among option players, and from a contrarian point of view implies bearishness. But as you can see in the last column, based on back tests, some stocks actually outperform when call purchases outweigh put purchases. The highlighted ticker is Western Digital, ticker WDC, which on February 29th showed its 10-day buy to open call put ratio at 9.27, ranking in the 94th percentile of its annual range. According to our back test, Western Digital shares declined 1.84% on average over a 21-day period. This is significantly less than the 21-day average return during all other times, which was positive at 1.95%. That day, we issued an alert to purchase WDC puts, which did go on to drop in the following week. This trade still remains open today. That's all I got for you today. I hope everybody watching me were able to get at least one nugget of insight that you can adopt in your own trading. If you'd like to visit us at www.schaeffersresearch.com, it'll be great. Thank you so much and have a great day.
Awesome. Tony, appreciate you hopping on with us.
Thank you so much for having me. I appreciate it.
Absolutely.